Hey team, it's Matt from Universal. Thanks for checking out this video where we'll calculate the PE ratio for companies in the same industry and we will find that hidden gem, I promise you. Now, before we get into the video, please subscribe to our YouTube channel. If you're studying for the exam, join our Facebook groups. And then lastly, if you have not tried the Universal platform, please take advantage of our free 14-day trial. You're going to love it. And then lastly, ask us about any promotions. And if you've already purchased another review course, but it's just not getting the job done, ask us about the Spilt milk program, right? Who doesn't love Spilt milk? Now let's dive into the video. So this is a great question because there's two steps we need to do. If you read through, we basically are given the stock price and earnings per share for 4 companies. Now, these 4 companies all have the same growth potential over the next 5 years, and Samaj, who's an analyst, needs to figure out which company appears to be the most undervalued relative to its peers based on their price to earnings ratio. So when we think about the price to earnings ratio, well, what we'll do is take the stock price, divide that by the earnings per share, and that ratio, we can then use to compare these 4 companies. And ultimately, we'll figure out which one is undervalued and maybe which one's overvalued, and that will help Samaj, crush it at Gold Coast Equity Partners. So the first thing we need to do is calculate the PE ratio. So it's really simple, right? We got the 4 companies, we have their stock price, and we have their earnings per share. Well, all we need to do is divide the stock price by earnings per share, and that gives us the PE ratio. So we can see for Blue Water Club, the PE ratio is 5. For Sandy Beach Club, it's 25. For Dolphin Club, it's 4. And for Great White Club, it's 20. So when we look at this, right, Dolphin Club has the lowest PE ratio. And since all these 4 companies are in the same industry, same growth potential, we could look at this and say, wow, even though Dolphin Club does have a stock price of $500 per share, they must have fewer shares because their earnings per share is $125. So because of that, right, they are earning a lot more per share for each share of stock that I, as an investor, would own, right? So that is how we can use the PE ratio to determine if a stock is undervalued or overvalued. So in this case, Dolphin Club, they would be most likely undervalued relative to the other companies. And then Sandy Beach Club would have the most value or be overvalued, right? So keep that in mind. This is all about calculating the ratio and then learning how to interpret the ratio. So the correct answer here is going to be Dolphin Club.